Anush Raghavan, President at CMS Info Systems. And Anush, thank you so much for joining with us this afternoon. I want to just talk about your numbers, right? When you look at it, you've already achieved the revenue of more than 1,000 crores in the first half of the year. You've given a guidance of around 2,500 to 2,700 crores for FY25. FY24, what's the growth rate and what is the end year target that you have for FY24 as well for revenue?
Good afternoon. Thank you for having me on the show. No, I think we are quite delighted with our performance. Like you rightly said, we had given a 4-year guidance to the market of doubling our revenues on a FY21 base of 1,300 crores and growing that to 2,500 to 2,700 crores. We have delivered almost a 20% revenue growth over the last 3 years, which is in fact ahead of our guidance. For the most immediate quarter, Q2, we've grown our revenues by 15%, but in fact, in addition, also delivered a PAT growth of 25%. Which is almost a continuous record of 20% plus growth for the last 6 quarters. So we feel quite bullish about our prospects. We are very confident about where we are and in our current trajectory and in being able to achieve our revenue goal of 2,500 to 2,700 crores. We continue to focus very strongly on our quality of operations. That in fact helps us a lot in terms of being able to achieve very strong margins. We have 17% PAT margins in this quarter. And both our businesses, cash and managed services, are not close to 25% plus EBIT contribution.
Right. Also let's move on and just talk about, in terms of the revenue contribution from those managed services as well as tech solutions, that has been on the rise as well now. But the EBIT margin there are still a bit lower when you compare it to the cash management business. So if you could give us an understanding in terms of that and what is the outlook on margins for this segment as well?
Absolutely. So, around the time when we went to the IPO, we spoke about a robust order book because at that time, the MS or managed services and tech business was a much smaller driver of our overall revenues. So in order to give the visibility to the markets about what sort of an order book we have and how they can sort of estimate the growth of that business, we had a 2,200 crore order book in December 21 when we went to the IPO. In March 23, that had grown to about 3,000 crores. And in first half of the year, we have in fact added 650 crores of new wins only in our managed services and tech business. And 500 crores of that has come in the second quarter. The type of work that we do in managed services is more about helping banks with incremental outsourcing, helping them increase their reach and provide greater technology services. Some of this necessitate a bit of capital and allocation. However, the 500 crores that we won now are all asset light. Consequently, you will find that the EBIT contributions of cash and MS are not necessarily comparable. But you should also keep in mind that over the last 3 years, we have continued to increase our return on equity to our shareholders, despite the investments that we made in CapEx.
Anush, Somit this side joining into the conversation. So my question is specifically on the receivable days. It has increased by nearly 17 days. It was earlier 100 days. It has now increased to 117 days. So why this has increased first? Because this is one of the concerns among the analyst community for CMS Info System. And how do you see that coming down going forward?
Absolutely. So I think if you look at it in 3 halves, Somit, right, between H1 last year, H2 of last year and H1 of this year, you will find that there is a certain natural cyclicality to the nature of the business. First half is usually a little bit soft, and then we end up picking up towards the second half of the year. So likewise, last year, we started H1 at about 106 days, and we ended H2 at about 100 days. So that 6 to 7 days is pretty much the cyclicality. Second is the nature of the projects that we've executed across H2 and H1 of the year have been fairly large transformational deals that we've done for some large public sector banks. Conversion of that into billing and collection usually ends up taking a little bit of time, especially as us and the customers are getting conversant with the process of billing and collecting money. And thirdly, with increasing interest costs in the country, every business is tending to hold on to cash a little bit longer than what they would do earlier. So it's really the contribution of these 3 things which have stretched the DSOs a little bit. But as we move into the second half of the year, we are quite confident of being able to pull back on this.
Okay. And when it comes to the order book, you have won around 650 crore of order in the first half of financial year. And given that 51,000 ATM RFPs are expected to come in for the full financial year, what is the order pipeline looking like for the second half?
So after the 51,000 RFP pipeline, I think about 30% of those have had RFPs which have been concluded, but close to 60-70% of those are still work in progress, across several large public sector banks. So we feel quite confident, given the sort of capabilities and strength that CMS has built on the back of its distribution network in the cash business, on the back of technological capability in the managed service business. We feel quite confident about how we are poised to try and grab a slice of this pie.
Right. Just one more thing. I just want to understand a bit more in terms of margins also. Year-on-year basis, this time we're seeing a bit of a contraction coming in terms of the margins. That was largely due to those ESOP charges. What is the margin guidance that you would give for the full year?
So we don't actually give a margin guidance in the business, but you again look at our history of the last 3 to 4 years. I think we've had a robust history of being able to execute extremely well and continue to expand our margins. The delta you're seeing on the margins is only because of the ESOP cost, but I would just like to also bring to notice that it is really a non-cash expense for us. The ESOPs that were issued pursuant to an approved shareholder policy will cause a non-cash expense of about 10 crores for the next 6 to 8 quarters. But all of these ESOPs have been, most of them, at 75 to 80% of them have been issued at fair market value, and they have been linked to certain performance criteria.
Anush, thank you so much for joining in with us this afternoon on ET Now, giving us an understanding in what we should be expecting from the company going forward and the outlook for the company as well.